Hello everyone, and welcome back to the Web3 Daily. Let's dive into what's making waves in the market today. At first glance, the market today seems a bit dull. Bitcoin is just hovering around the 108.0 mark, not really making any big moves. And the market sentiment index is pointing to neutral. You might think everyone's just sitting on the sidelines, but if you believe that, you might be missing the real story. Beneath the calm surface, there's a powerful undercurrent. A major capital migration is quietly underway. Let me tell you, the market dynamic right now is fascinating. It feels like a stability paradox. You see, while Bitcoin spot ETFs have seen outflows recently, Ethereum spot ETFs are attracting a massive influx of cash. What does this tell us? It shows that the mindset of big institutions is shifting. They're no longer viewing the crypto market as a monolithic entity. Instead, they're starting to be selective. In their eyes, Bitcoin is perhaps becoming more like digital gold, a hedge against macroeconomic risks. Meanwhile, Ethereum, with its staking yields and vast DeFi ecosystem, is increasingly seen as digital oil, an asset that can generate continuous cash flow. So don't be fooled by the current market calm. It's actually the result of conflicting investor sentiments canceling each other out. A grand spectacle of capital rotation based on value discovery has only just begun. Speaking of institutional mindsets, have you noticed that the crypto market is no longer just a financial game? It has quietly escalated into a grand chessboard for global powers, with the US and China as the main players. When I first saw this news, my immediate reaction was, this show is getting more and more intense. Donald Trump's son, Eric Trump, recently made a fiery speech at a Bitcoin conference in Hong Kong, calling China a hell of a force in the crypto space. Almost immediately after, US VP candidate JD Vance followed up, calling to use Bitcoin to counter China. See, this isn't just a war of words anymore. They're openly talking about cryptocurrency as a strategic national weapon. What's even more interesting is a stablecoin bill being pushed in the United States. Many see it as a strategic move with a hidden agenda. On the surface, it's about regulation, but in reality, it's a direct challenge to China's capital controls. Just imagine a world where USD stablecoins circulate freely everywhere. What would that look like? Of course, China isn't just sitting back and watching. Their strategy is fascinating, a mix of internal control and external flexibility. On the mainland, they have a strict firewall to keep risks at bay. But in Hong Kong, they've opened a window, treating it as a sandbox to experiment with regulated stablecoins and ETFs. This dual approach of blocking and experimenting is meticulous. So, as you can see, this contest has evolved from a purely technological and financial issue to a geopolitical one. And for those of us in the market, it feels like we're pieces on this giant chessboard. Every move made in Washington and Beijing could directly impact the size of our wallets. Speaking of Hong Kong as a sandbox, it just dropped another bombshell that has the entire traditional finance world on the edge of its seat. Hong Kong recently officially launched its stablecoin regulatory framework, which is one of the most advanced globally. As soon as it was announced, it attracted interest from over 40 institutions. We're talking big names like Standard Chartered, Circle, the issuer of USDC, and the Metaverse player, Animoca Brands. All the heavy hitters are showing up. But what's the most mind-blowing part? The latest news is that Bank of China, Hong Kong, yes, you heard that right, that Bank of China has already set up a dedicated team to explore applying for a stablecoin issuance license. The moment this news broke, its stock price in Hong Kong skyrocketed. Let's really unpack this signal. This is no longer just about embracing regulation. This is a top-tier giant from traditional finance, preparing to become a major player in Web3. Just think about it. When an institution like Bank of China enters the game, they bring not just the money, but a massive user base and unparalleled credibility. This move essentially cements Hong Kong's status as a digital asset hub, and on a larger scale, this could also be a new pathway for the internationalization of the renminbi. So, Hong Kong's move isn't just setting a precedent for global crypto regulation, it's rolling out the red carpet for all the traditional finance giants still hesitating at the gate, showing them a clear path into the world of Web3. While Hong Kong is rolling out the red carpet and issuing licenses, the US across the ocean hasn't been idle. They're busy reinforcing their own walls and installing more powerful surveillance cameras over the entire market. The US Commodity Futures Trading Commission, or CFTC, recently announced a major move. They are officially adopting Nasdaq's market surveillance technology. This is no small thing. The system Nasdaq uses is designed for the stock market, specifically to catch illicit activities like market manipulation and money laundering. Now, this eye-in-the-sky system is being aimed directly at the crypto market. The reaction to this in the crypto community has been fascinating, a real mixed bag. On one hand, the big institutions managing trillions of dollars, like BlackRock, are probably celebrating. Why? Because their biggest fear is an opaque and unregulated market. Now that regulators are armed with Nasdaq-level technology, it's like a huge vote of confidence, signaling that the market is cleaning up and they can come in with greater assurance. From this perspective, it's definitely a long-term bullish sign, a mark of the industry's maturation. On the other hand, many of the old guard in the crypto space, especially the OGs who champion the spirit of decentralization, are surely unhappy. They're likely thinking, here comes Big Brother. The whole point of crypto was to escape centralized regulation and surveillance, right? Now you're bringing the stock market's playbook here, so what's the difference? This situation perfectly illustrates the core conflict facing the crypto world today. The idealism of freedom and anonymity versus the pragmatic need to embrace the mainstream and attract trillions in capital. And it seems the scales are tipping toward the latter. Speaking of regulation and money laundering, a huge scandal just erupted in neighboring Taiwan, involving a staggering 72 million. It's being called the largest crypto money laundering case in the region's history. The fascinating part of this case is the criminals' sophisticated methods, blending online and offline tactics. They operated physical exchange shops to appear legitimate, while simultaneously using various online mixing services to launder the dirty money. This operation brutally exposed the regulatory loopholes in the local system. This major case has sounded a loud alarm for Taiwan's regulatory authorities, and the consequences will be swift. A regulatory storm is brewing. Just watch. We're about to see a wave of stricter policies. For instance, all exchanges will likely be forced to implement more rigorous KYC and AML checks, and we might even see restrictions on high-risk activities. Honestly, this is a classic growing pain for any emerging market. Whenever a new technology grows rapidly, it inevitably attracts bad actors. Scammers and speculators are always the first to arrive. In the short term, tightening regulations might feel restrictive and make trading less convenient for the market. But in the long run, it's like a necessary deep clean. You have to clear out the trash to allow genuinely valuable projects to grow healthily and attract more legitimate capital and participants. Alright, after covering the serious topic of regulation, let's switch gears to a project that's loaded with hype and controversy, featuring a familiar name, the Trump family. A DeFi project called the World Liberty Financial has been grabbing all the headlines recently, thanks to a public endorsement from the Trumps when its token, WLFI, went live. Man, it was a wild ride. The market cap shot up like a rocket, at one point exceeding an insane 30 billion. I could feel the FOMO in the community right through my screen. But, as with any roller coaster, the most thrilling part is often the drop. The rocket fuel burned out quickly, and the price came crashing down just as fast. The reason was simple. Early investors and insiders started unlocking their tokens and dumping them on the market right at the peak of the hype. A massive flood of tokens hit the market, and the enthusiasm of retail investors was instantly extinguished. This project is a perfect case study of the celebrity endorsement model in the crypto world. It teaches all of us a valuable lesson. When a project's biggest selling point is that it's backed by a celebrity, you need to be extremely cautious. The logic is straightforward. Immense celebrity influence can create incredible market hype in a short time. But when the tide goes out, the selling pressure from early investors' unlocked tokens can be the final straw that breaks the price. So, when we invest, we really need to discern whether we're buying into a project's long-term value or just paying for someone else's celebrity status. You have to be careful not to become the exit liquidity for others cashing out. The market risk is incredibly high. After looking at a hype-driven project like the Trumps, let's turn to a truly game-changing piece of news from the US government itself. Personally, I believe the long-term value of this news is greater than the previous items combined. The US Department of Commerce recently did something unprecedented. They began publishing macroeconomic data like GDP directly onto 9 major public blockchains, including Bitcoin, Ethereum, and Solana. Through oracles, the technology providers making this happen are leading oracle projects like Chainlink and Pyth. When I saw this news, my first reaction was that this is an absolute milestone for the industry. Have you ever thought about what this truly means? It means the US government is through its actions, acknowledging public blockchains as a serious, reliable, and transparent channel for data distribution. This is like giving the entire blockchain technology space, especially the Oracle sector, an official stamp of approval. For DeFi, this is an even bigger boon. Previously, on-chain financial protocols had to rely on various third-party data sources of mixed reliability to get real-world information, and now they can directly tap into the most authoritative first-hand data from the US government itself. What will this enable? More complex and trustworthy on-chain financial products. Imagine derivatives directly linked to real GDP figures, or algorithmic stablecoins that automatically adjust based on official inflation data. This development elevates the potential of DeFi to a whole new level. So, while this news might not pump prices like a celebrity tweet, it's quietly laying down an incredibly solid piece of infrastructure for the future of the entire Web3 world. This last piece of news perfectly circles back to the stability paradox we discussed at the beginning of the show. Now, with more specific data, we can see exactly how the smart money from institutions is moving. The latest data shows that this past August, Ethereum spot ETFs attracted approximately 4 billion in net inflows. Meanwhile, Bitcoin spot ETFs actually saw about 2 billion in net outflows. This divergence, a 6 billion swing, is a signal too strong to ignore. So, why is this happening? The logic is quite simple. With Bitcoin's price entering a consolidation phase for large institutions that prioritize capital efficiency, money sitting in Bitcoin becomes dead money. Consequently, they start searching for alternatives with higher returns. And Ethereum is the perfect candidate. Just think about it. Ethereum now offers pause staking yields. By holding it, the asset itself generates interest, like a hen that lays eggs. In a sideways market, this stable yield alone is incredibly attractive. More importantly, Ethereum is backed by a tremendously vibrant ecosystem of DeFi, Layer 2s, and various applications. In the eyes of institutions, investing in Ethereum is no longer just about investing in a single coin. It's an investment in the entire future of the Web3 application layer. Therefore, this capital rotation from Bitcoin to Ethereum might be more than just a simple portfolio rebalancing. It could very well be a leading indicator for the next phase of the market. This stream of institutional capital, after nourishing Ethereum, is likely to flow further down into other high-quality projects within the Ethereum ecosystem. So, for us, keeping a close eye on the direction of this big money flow might be far more important than staring at price charts. Alright, that's all for today's Web3 Daily. If you found this helpful, be sure to hit that like button to show your support. Every day, we sift through the noise to bring you the most critical insights from the Web3 world, the news that's closest to the money. Our goal with this curated content is to help you make more rational and informed decisions on your Web3 investment journey. Also, I've dropped exclusive sign-up links for major exchanges in the comments below. These come with special high rebate deals we've secured for our community, hopefully saving you some costs along the way. Let's all stay rational, move steadily, and build our wealth in the Web3 space. May everyone's crypto portfolio see steady growth. I'll see you tomorrow.